Welcome to the My Amazon Guy podcast. I'm now joined by Ken Kubec, who is the VP of Acquisitions at Thrasio. Thanks for coming on our podcast. This is going to be a blast.
Yeah, thanks for having me. I'm excited.
So you guys are the largest Amazon aggregator. I think that's pretty uncontested. Raised $1 billion last year, another $750 million last week. I saw publicly announced. So everybody wants to hear from you, and I'm really excited to talk to you, Ken. Just to tee up a little bit about you and maybe some just general history on Thrasio as an Amazon aggregator. Can you first tell us what an Amazon aggregator is, and then maybe a little bit about your own personal background?
Yeah. So, an Amazon aggregator in broad strokes is hopefully a well-capitalized organization that is building out a platform to ingest / acquire Amazon private label brands of a certain scale and put them into their operational platform and ideally accelerate the growth profile. What I think in the early days, what we saw was that there tends to be a natural ceiling for most entrepreneurs in the Amazon ecosystem, and that ceiling typically revolves around capital as well as expertise in certain functional areas that are becoming more and more important within the Amazon ecosystem, i.e. supply chain and marketing. And we saw a need in the marketplace to provide that added benefit of it as a scaled operator to entrepreneurs, and also give them an opportunity to exit the business once they've taken it to the point where they either are just tired of running it and need capital, or they're all starting another brand and want an exit.
Amazon is passive income, though, and it's not hard work, and nobody ever burns out.
4-hour work week.
Mom during kids' nap time, right? So yeah.
Yeah, exactly. Trust me, we wish that was the case. It was readily apparent in early days that is not the case. And so speaking of the early days, right? We had two co-founders, Carlos Cashman and Josh Silverstein. Both serial entrepreneurs, just great business-minded individuals that had crossed paths, before Thrasio. Carlos's most recent endeavor was one of the leading Facebook ad agencies, and so he and Josh had been talking, and Carlos, a lot of they were running and scaling D2C brands, via Facebook ads and Google ads, etc. And increasingly, a lot of the brands were coming to them saying, "Hey, you guys know how to run Amazon ads." And so Josh and Carlos have been kicking around, hey, we should go scale, buy these, startup D2C brands and scale them with, using agency resources, et cetera. And the more and more they dug into the Amazon ecosystem, they realized that there was a massive opportunity there to scale up and acquire, Amazon private label brands. And at the time, one-on-one commerce had started doing that. And it was really, there was no playbook for it, right? I mean, it was a lot of Googling and talking to brokers, and there was, a few brokers that were dabbling in the Amazon FBA space at the time. And, we never really, we'd like to say we had the foresight, but, we knew it was a large opportunity. But, in early days, it was, three deals here, 4 deals there that we were looking at. I mean, I joined in November of 2018 as the 8th or 9th person in the company. And we had made 2 acquisitions and raised, I think, $7 million of debt at the time. And, and to be candid, early days, we thought, hey, if we could get this to 100 million in revenue and at a, 20% profit margin with 25 people, that's a great business, right? Maybe then we can, as an aggregate some assets, and maybe we sell that to private equity, or we just run it as a great cash flowing business for everybody involved. 2 things happen. One is we realized that it's a lot harder than we thought to run these brands, right?
Yep.
Yeah. And 2, that it's a much larger opportunity than we initially thought, right? Because you know, again, in early days, it was, hey, there was a few opportunities to, businesses that were being marketed by brokers to acquire, and it wasn't really known in the Amazon ecosystem and circles that you could actually sell your Amazon business, right? It was, there's a lot of questions around, is it against terms of service? How does Amazon view it? How do you do it? How do you transfer accounts, et cetera, right? And it's just amazing to have a front row seat to the evolution of this amazing marketplace, right? I mean, everything from, talking to sellers and, now, I mean, valuations and the velocity. I mean, our pipeline today is, and this is not even an exaggeration, 20 times the size that it was 2 years ago. Right.
None of this surprises me. We've seen a lot of market forces, and you guys are part of the market force. You rode the wave, and now you are the wave in some ways. So people are definitely excited to hear, more about Thrasio, what you guys are up to, what you're thinking about, all that good stuff. So we'll dive into as much as you're willing to share on any of that today. So when did kind of tying the history and trying to bridge the gap between the beginning and the two things that happened, when did you think that like the momentum just like really happened?
Yeah, I think it was, right. I mean, part of it was capital that we had. But, I spent so my role in the company is kind of sourcing all the deals, negotiate, figuring out which companies we'd like to acquire, negotiating the deals, and, signing the offer letter and the term sheet. So I kind of call it the tip of the spear, right, of Thrasio. And it was really, I mean, I think it was in 2019, March, we're like, hey, we should, we were talking internally. I'm like, we should go to this Prosper show. And, it's a huge Amazon conference. We should just get a booth, and John, and John, our SVP creative, he's a brilliant creative mind. He's like, we should just put up a banner that says, we buy Amazon businesses. And so we're like, great, we ordered it. We go out to Vegas. And we're sitting there, and people are like, "So you guys like a broker, or what do you, what are you doing? I'm like, we buy Amazon businesses." And they're like, "And then do you sell them? Do you sell them to other people?" We're like, "No, what do you do with them? We run them." Yeah, what do you do with them? Like, no, we're running them. And so, we basically did kind of a world tour. The first 18 months. And that was, I think, really instrumental in getting, we were not only being evangelists for Thrasio, but also the market and the opportunity, right? Like that you can actually sell your Amazon business. And, we have a process, and we were obviously developing the process about how, kind of now call it a conveyor belt, but about how you actually go about doing that and expressing confidence in it. And it was really, I mean, just that was probably, that started the snowball effect. And then I would say it was really early last year, once we kind of, did one of our larger, at the time, our largest capital raise. And really we, on the M&A team, we really dialed in our process to where, we had a lot of confidence in our process, and the velocity just really started to ramp, right? And that was probably early, 2019 or 2020, sorry.
A phrase I like to use is the scale of no return. And basically what I mean by that phrase is like, you hit a certain point, there was no looking back. So businesses that grow at exceptional paces hit that scale of no return, and like your entire organization has to restructure. You have to totally different business model. Do you have any advice that you could offer? Take my Amazon guy for an example. We're an agency trying to level up right now, and we're hitting the same scale of no return on a very different scale than Thrasio, obviously. But what would you say to businesses, entrepreneurs out there that they're having exceptional success? What do they need to do to like break through that glass ceiling, so to speak?
Yeah, I mean, picture who you want to be when you grow up, and plan for that and attack it, right? I mean, I think if people always ask me all the time, what's been the biggest ingredient or success factor for Thrasio, and it's fortitude. It was vision and fortitude, right? I mean, we had some of our early acquisitions were, turned out to be not so great, and we stumbled. But when you're doing something at such a scale and speed, particularly on an acquisition, if you're running the same playbook, right? Those first acquisitions you're building equity, you're not building enterprise value, right? Like you're figuring out how to do it, you're figuring out what works well, what doesn't work well, and you're defining the formula. And it's the same thing in a business, right? If you're running an agency, okay, how do you onboard, and what are we really good at as an agency, right? What's our sweet spot? And I think once you define that, that's when you go for broke, right? You find that, quote, in technology and software, they always talk about product market fit, right? I think when you find that and you have the utmost confidence that you have it, that's when you really go for broke and, scale up.
So I may dig in a little bit with this go for broke statement. I'm curious what you mean by that. Kind of to set up the question here, there's ground that you can defend as a company, right? Like there is an immense amount of ground that you can focus on or not focus on. So like choosing that ground, I mean, you guys shot for the stars, right? And raised record-shattering amounts of capital. Is there ever a point where you say, hey, we've bought too many, or do you think it's infinitely scalable based on your success?
Yeah, I mean, I think at this point it's infinitely scalable, right? I mean, we know how, right? We've modularized the operations, right, to make it scalable, right? So everything from the acquisition process is extremely scalable at this point. And even the brand management is I would say very scalable, right? The day-to-day, operations, and we have forecasts internally, over the next 2 years, like where we think we're going to be, acquisitions, et cetera, and we're planning. We've hit all those metrics, and the people org is planned all around that forecast. And so we're hiring ahead of the acquisitions, obviously. So there's an easy handoff. And I mean, this is what has me so excited is that, we joke internally about Thrasio years, right? Like dog years.
Oh my goodness. I know where you're going with this. Yes.
Right. It's like, oh my gosh, like we were just laughing, John, Brandon, Stephanie, we're just laughing about this morning, but it's, when you're going that, quickly, it's easy to, think that, wow, we've done it, right? It's like, this is amazing, and sit back. And I'm so excited because we're pushing even faster and harder. And at the end of this quarter, we're already well over 100 acquisitions, right? We'll probably double that this year. And there's 30,000 Amazon sellers doing over $1 million a year in revenue just on the U.S. marketplace alone, right? I mean, in terms of scratching the surface, we're basically getting out the knife to etch. You haven't even etched, right? I mean, and then if you think about all the other marketplaces and D2C, which we can discuss, that we're obviously getting into, it's a $14 trillion marketplace globally, right, for consumer products, and that's what we're attacking.
There's a lot to unpack with what you just hinted at. There's two questions that come to mind. So the first is the scratch of the service comment, and that was, so if we use a baseball metaphor, I've been, like, me personally, I've been trying to crack this in the last 30 days. I've been trying to figure out, with the Amazon aggregator model, with everybody pouring money into the space, are we in the second inning or are we in the fifth inning and people just didn't pay attention? I have a personal opinion. I'll let you go first, though. Where do you think we are? Do you think we're in the second inning and it's just scratching, just like you mentioned, or do you think we're deeper in and people just haven't seen it?
Yeah, look, I think we're in the second inning, to be honest with you. Now, we can talk about. I think there's probably a little bit of short-term bubble frenzy, right? That has come in. And a host of reasons, right? You've had massive supply and demand, right, on both sides, taking the market up to a feverish level, right? I mean, from a supply standpoint, it's a great time for a seller to be exiting, right? Because you're being valued on your trailing 12 months profit, which unless you were in a travel category or something that was, dramatically negatively impacted by COVID, your numbers look awesome, right?
Yeah, I would agree.
Right. So, and come March, next month, April, May, people are going to start comping up against big numbers that they put up in kind of the peak COVID frenzy of econ. And they're going to start probably showing year declines potentially, right? If they took pricing or the competitors ran out of stock and they just had these massive gains in revenue and profit in that time period. So I think the seller psyche, a lot of people are kind of, hey, I'm going to get while the getting's good, because you could be down 25% year over year, and that's a much tougher position to negotiate in the marketplace with. So I think there's this short-term euphoria that will dissipate, and we can discuss, but I think some of the aggregators are going to have a hard time getting to the next round of funding, and there's going to be a shakeout probably in 2022. So there is, right, like people have raised this capital, they got to deploy it, right? They're investors.
And then what did they do with it?
Yeah, what do you do with it? You say you're going to go buy businesses, you got to go buy businesses, right?
And then that's not even the hardest part. Then you got to run them.
Well, that's where the rubber's going to meet the road ultimately. But it's interesting. So the dynamics that we see is we're seeing a lot of activity, and I would say, look, there's a natural valuation and price for these assets, right? And on the 200 to 750,000, annual profit, that's like a frenzy. I mean, it's, they're listing with a broker, they're getting 10 offers in a 48-hour period, right? And honestly, we've kind of shied away from that because we think they're, look, we have data on all of our acquisitions. We know our track record, and the prices that are being paid in the market for those assets make us a little squeamish, a little skittish. So we've kind of gone up a little bit. We're still there. I mean, we're still making acquisitions in that space. Primarily with people who believe in the Thrasio story and the earnout performance payments that are associated with our offers. But we're not going to compete and pay, what we think are inflated prices for assets in that market.
So I think the value assessment that you're giving is spot on. I actually agree wholeheartedly with your assessment here. One of my thesis that I'm kind of working off right now is okay, what's going to happen when the aggregators have the call, right? Like when they bought all the businesses and then they haven't grown them, or how are they going to grow them, and how are they going to run? So I think a lot of the aggregators are in their early stages right now, and they have a lot to learn from you. Let's go ahead and go there. Give me one piece of advice that you would give the other aggregators.
Start slow. I would say, start slow, and you need operators, right? I think if you look at, these are questions I tell people. I did a presentation on it, like questions to ask, right? If you're a seller talking to a buyer, right? And you do have, look, if you're getting cash up front, it really doesn't matter if the whole deal is cash up front. There's no back end, performance contingency payments or anything like that. But I think there's operator backed, aggregators, and there's finance backed operators, right? I mean, I came from investment management. I analyzed stocks for over a decade and invested in public companies. Everything looks good on a spreadsheet. You can make anything work on a spreadsheet, right?
Arbitrage spreadsheets. I've heard that.
Yeah. I mean, trust me, it's not anywhere near as easy as people think it is. And that's what, look, early days, we were, you're asking about the inning and, were we quiet and are we in the fifth? I mean, we made a conscious effort to, kind of stay quiet and kind of, we were out there in the Amazon ecosystem, right? But we weren't, getting articles written in the Wall Street Journal and highlighting what we're doing, and to, finance-minded people that would come in and, private equity and things like that, because, we were building up the operational expertise, and because we knew how hard it is. And once we find, Yeah, really hard, right? So once we were like, wow, we are dialed in on Amazon operations, that's when we kind of opened up, the barn door and let the kind of Thrasio out into the, into the world, because we're like, look, we think we're so far ahead of everybody that's going to come in and try and do this. And we're so confident in our ability to operate that, look, we're here. This is what we're doing. This is what we've done. This is what we're going to do. And let people come into the market. And it's not a zero sum market. It's not a zero, right? I mean, we have over 100 deals we're looking at right now. We can't buy all 100 deals right now, right? I mean, and that's not even, I'm sure there's deals we don't see. I mean, it pains me to say that because, my number one objective is I want to see it. I want to acquire everything and I want to see everything, right? And at least have a shot at it.
Yeah.
But it's not a zero sum. So, I mean, I hope there's, successful people that follow in our footsteps, and I think there will be. But I also think I think next year we're going to be probably buying one or two of, the current aggregators is my guess.
That is a pretty easy statement to make, I think. So I think they'll do the job of rolling them up, and then that actually, I bet you, now that I think of this, because this is the first time I ever thought of this, your comment there, I hadn't drawn that conclusion myself. The more I think about it here, I bet you some of the aggregators, that's their main plan. That's probably
yeah. But they got it right. I mean, look, the risk in that is positive and negative momentum on Amazon is exponential, right? I mean, if you buy assets and you don't do a good job continuing the growth momentum and their presence in the algorithm, they're not going to be good assets, right? It's a lot of capital to kind of restart the growth engine on Amazon, and sometimes you can't put it back in the box, the genie back in the bottle once you've started a negative trend. So, and then if you're from a point of weakness, right? If you're levered up, if you've been funded with debt, which is the best way to kind of go, if you're good at operations. But if you're not, then your back's against the wall.
All right, so let's turn our attention over to selling to Thrasio. What makes you guys unique? That kind of context. The first question I have for you is, what is Thrasio looking for?
Yeah, industry and category leaders, right? So I call it the R cubed. So reviews, rank, and rating. So we're, for the most part, we're category and product agnostic. I mean, there's certain areas that we, shy away from. So, I would say fast fashion and apparel, shoes, foods. We can probably do a whole podcast on the nutraceutical space, but we've started to look there. More so simple ingredients, right? Not testosterone pills and things like that.
I actually discovered one ag that their main goal is that category. So yeah, it's interesting to see.
No, I mean, look, it's wildly lucrative, right? We totally get it.
But like 19 out of 20 I talk to, they won't touch it. They're like, I'm not interested.
Well, it's ground zero for black hat tactics because of the profit pool is so big and so and growing and right. And if you crack it, it's amazingly profitable, right? So there's that, technology. So, we have, a team in China now, and we're talking with them, and what we're hearing from factories, is, OEM, like technology, product iterations, a 2-month cycle right now. So good luck
and that's fast, right?
Yeah. And new product launches every 2 months, like actual physical products iterating every 2 months, right? So
it's crazy.
It's not. Yes. Yeah, like we're we always use the example of a spatula, right? Like we're looking for stable, steady, everyday demand products, and they could be niche, right? I mean, we have some very like niche products that you'd be like, oh, I didn't even know they sell those, right? Like I don't even know that's a thing.
So I discover new products all the time, and I'm like, how does this exist? It's like the unicorn meat on Amazon. It's like, what?
Yeah.
Right. So I bet you run into that.
Yeah, but the beauty of that is, right, I mean, I look at things and I say, you know, what's cool is when I find a product, I'm like, where else would you go find this?
Yeah.
Right? Like, you know, the physical retail store, right? Like shelves, like physical products are losing shelf space in the US.
You're not going to find a proven product on retail.
Right. Like where, you know, darts, where would you go to buy darts right now? Maybe Dick's Sporting Goods or some sporting goods store that has like 3 things. You know what I mean? It's like there's product after product that are experiencing this decay in physical retail that is moving online, and a lot of those products don't have the average order value or gross profit dollars that to lend themselves to a D2C model. So by default, they have to go to a marketplace, right? So it's products like that we look for. You know, we tend to focus in sports and outdoors, home and kitchen, you know, pets, auto, kind of, you know, just again, hard good items. And then it's just leadership, right? So our original thesis of Thrasio was, let's buy the players on the top of page 2 or the bottom of page 1 for, you know,
strike zone,
and move them up, right?
We like to talk about that in our phase 3 SEO strike zone, where 20 through 50 and a little bit of effort would get you to the top of page 1.
Yeah, right. So, well, what we found was we don't know how the hell to do that when we started.
There isn't this Amazon playbook you get a PhD in by going to college?
Yeah, no, I wish. No, people come to Thrasio now to get it, you know, on the operations side. But no, we didn't know how the hell to do it. So then we said, all right, well, why don't we buy the business that have done it, right, and put the capital and resources behind it. And what was great, that was the great thesis, and that is our thesis today. But what we found was, wow, you know, playing offense, but now we need to know how to play defense, because now
you're at the top and everyone's are coming.
Yeah, everybody's coming for your market share, right? And you need capital, right? You need capital to do that. You need to be able to run, you know, deals of the day and get placement for the deal of the day and lightning deals, and you need to know how to drive, you know, high converting external traffic to the listings and really leverage that, you know, that leadership position on Amazon across other channels and other marketing channels. And that's what we're doing. So I think, you know, our big wins have been, you know, we've had a lot of them, but the really big ones have been, you know, the 10,000, 25,000 reviewed products that have this social proof that we're able to then really leverage both within Amazon and outside of Amazon.
This month, Amazon had its first 1 million review product. It was the Echo.
Yeah, their own, yeah.
Yeah, so it's gaining 100,000 reviews a month. It's kind of insane.
I mean, it's insane.
So the most common question I ever ask on my podcast is, what would be one tip that somebody could do today to grow their Amazon sales? Would you like to take a crack at that if you're willing to share anything?
Yeah. So ride your winners, right? This is something that I think a lot of, like, you know, go to a lot of conferences and talk to, you know, a lot of, you know, podcasts and stuff like that. And people are always like, you got to diversify. Like, Amazon's the big bad wolf. They're coming for you. And I always say, look, you need to, you know, I learned this in investing. Like, you only get so many great opportunities. And when you have them, you got to ride them out until they fulfill their destiny. And that's why, I mean, I would launch one ASIN and in a big market, and, you know, just head down, work on that ASIN nonstop, right, until you feel like you've gotten to a point where it's getting close to, you know, maximizing its value and its position on Amazon. Oftentimes what we see is, right, particularly for entrepreneurs that are, you know, taking out credit card debt, taking out a second mortgage on their home to finance working capital and inventory, is they then, you know, I've turned it like diversification, right? It's like you start spreading out your capital among all these new product launch ideas and, setting up a Shopify
It's so fun coming up with product ideas, and I've got a closet of demo products that I'll never launch and an Excel sheet of 40 product ideas. How do I get it out of my head? Yeah.
Yeah. No, I mean, just make a great product, right? Fine. I mean, as our product launch team that, is launching, new products under brands we've acquired, but also white space brands, right? Like maniacally go through all the reviews of all the leaders, see what people are commenting on. Like, how do you make a better product, right? I mean, at the end of the day, that's what it comes down to.
Ken, if you guys are going to launch a new yoga mat, I recommend a sticky yoga mat that doesn't smell. There's 10,000 reviews that talk about that.
Yeah, exactly, right. So then maybe you're putting an antimicrobial coating on it, right?
Yeah.
That right, and that's like a perfect thing, right? Like that's
here's where you reveal that you own like 3 yoga mat brands, but
no, actually, no, we don't. We don't own mats. We don't own mats.
All right, guys, that one's safe. Thrasio's not in mats yet. Go chase that one.
Or come to us, yeah.
or that's if you sell yoga mats, Thrasio wants to talk to you. All right, so I'm going to ask kind of a Shark Tank question for you. So when somebody goes on to Shark Tank, they get to talk to multiple quote unquote sharks, right? And so when somebody wants to sell to Thrasio or go sell to somewhere else, they can, why should they talk to you versus go to the broker, I guess, is one of the most common questions I get. And so I know it's not an easy question, but if you're willing to tackle it, what would you say?
Yeah, no, look, I mean, I would say brokers are great. I mean, we buy businesses from brokers, right? And they have a lot of the buyers are there. It's more of a process. And then you're going to do a lot of calls and speed dating, and you're going to have to prepare a lot ahead of listing with a broker in terms of financials and, have everything buttoned up, right? You got to help put together, the 25-page offering memorandum and things like that. For us, it's really, look, for the businesses that fit our criteria, we're probably the ultimate buyer anyways, right? So what we say is, look, come to us as you are is our motto. Like, we can build your model. A lot of businesses we talk to, like, oh, I don't have, I'm using Seller Legend and I don't even know if it's right. They don't have a QuickBooks or an accountant, and they don't have to go spend $5,000-$10,000 to get their books tied off by an accountant, right? I mean, it's one of the beauties of this space is there's a canonical source of data in Seller Central. Like, that is the data, and then you just really need to reconcile the cost of goods sold, with supplier invoices, etc. So I think coming to us is you're going to get, somebody who's done it. We close on 96% of the term sheets that we sign. I'm hearing a lot of sort. Yeah, right. And honestly, two of those that didn't, they walked away during peak COVID in April, May, because their sales were up 300% in a month, right? And they're like, wow, I can't sell. We're like, yeah, we get it.
Totally makes sense.
Yeah. So look, we do what we say. Integrity is, one of our key values in our company. We're good people to work with. We've bent over backwards with sellers. I mean, we've seen it all, right? So that's a big thing. I think, we've had a product catch on fire, like the day we were going to sign.
Like literally, or
not like in flame, but it like a burning smell, and it was a faulty batch of products, and we restructured the deal to make sure that we improved the product quality and et cetera, and worked with the supplier. But we wound up closing the deal, right? Like, we've actually bought deals that other aggregators have walked away from in diligence because a product got suspended for 7 days. Like this is the world we live in and have lived in for the past 2.5 years. Like we've experienced it all.
You have the operators that know how to handle those situations.
Yeah, nothing's going to scare us. Like, again, we've seen it all, and we're hearing, a lot of people are, one of the tactics that some aggregators are doing is they're promising big valuations to sizable businesses, Amazon sellers, and then they're going to get funding based on the term sheet. And they're like, hey, they'll go to their investors and say, hey, we have this deal under LOI. Like, we just signed a term sheet. Do you want to come in and, provide capital for the acquisition? They don't even have the cash on their balance sheet to make the acquisitions.
That's
right?
Pretty damning, actually.
Oh, it's happening. I mean, I tell sellers, I'm like, ask to see a snapshot of their balance sheet. They should be able to provide you with an audited balance sheet that has the cash on it to make the acquisition. It happens. I mean, it's happening today.
So that brings up, I guess, a really good question. What should sellers be asking aggregators or whoever they want to sell to? What should they be asking?
Yeah. How many acquisitions have you done to date? Right. I mean, are you the first? we heard John, we heard a story a couple, 2 months ago from someone that signed on with an aggregator, and the aggregator was basically like, okay, so do you know what we do next? after they sign the term sheet, right? Are we your first? And look, we had a first, right? I mean, everyone has to have a first, but you need to know, hey, there's going to be some fumbling through, right, in the dark, and it might not go as smoothly as it could go, and it might not consummate, right? So that's number one. So how many deals have you done to date that you've actually closed? Number two, what's been your performance post acquisition? This is really important, right? We on average, we're going profit at 156% the first year post acquisition.
That's a huge number,
right? We haven't raised the amount of capital we've raised if we're not performing, right? And get the valuations that we're getting in the market. So that's important, right? Because a lot of everybody has obviously copied us from the 45-day close process that everybody's website has now.
I think they're pushing it to 30 now. Honestly.
30, yeah, good, yeah. I mean, yeah, you can't do 7-minute ads.
I just set my ads up and forget them, right? That's just how it works, right? The campaigns up, never optimize them. It just all works out.
Yeah, right. Everyone followed that. Everybody's followed our deal structure too. So our deal structure is basically, significant portion of cash up front, and then we let the sellers participate in the future upside that we drive in the brand and the business over a period of 2 years, and it can be as high as 50% of incremental profit that we drive, right? So if we buy a business doing $1 million in trailing 12 months profit, they're getting a sizable cash payment at the close and the migration of the assets, and then we say, hey, we're going to give you 50 cents of every dollar over $1 million for the next 2 years. I mean, so. Look, with
a proven track record, that's a pretty compelling thing.
Yeah, right. You're getting, a couple million up front, and then we take it from $1 million to 2.5 million. You're getting $750,000 at the end of year one bonus, and then in year two, let's say we take it to 4 million, from 2.5, you're now getting another 1.5 million because the baseline was the $1 million, and now you're at 4. You get half of the 3 million delta, right? So, and other people are in the market doing this, and look. And they're saying Thrasio doesn't pay their performance payments. They're liars. I mean, because that's the only way they can assail us and win deals is to try and discredit who we are. And we're not going to
doing behind the scenes, so that they're grasping the straws. And I know that because I have no idea what you guys are doing.
Look, I mean, we're so big now that I kind of have no idea behind the scenes. It's just, I mean, I see the numbers. And I know the caliber of people we're bringing into the organization is amazing, and surrounding, from a board level and et cetera. So that's important, right? What's your performance, all right?
So not
go ahead. No, go ahead, Steve.
So not every brand is a Cinderella story, right? So there are some stinkers that you buy who won't get a profit check, so to speak. How do sellers protect themselves, right? So let's say that the seller's like, oh, I've got the best product ever. The deal goes through, and then your team says, you know what, we should put resources somewhere else. Like, how do you address that? Just curious.
Yeah, I mean, we encourage sellers to stay involved, right? So, sometimes we'll sign them up to consulting engagements. We've had 2 teams that we've acquired have actually set up product launch pods within Thrasio. I mean, they're full Thrasio employees with benefits, et cetera, building out awesome engineering and product launch teams. So it's really, yeah, I mean, I would tell people to stay, ask to stay involved, right? Like communicate with the brand managers, and, the way we're structured is we have brand managers that oversee the day-to-day brands, but they leverage centers of excellence to do the blocking and tackling of marketing and creative and supply chain, et cetera.
So when they're really, they still have like access to the accounts and they're still like working on it with you guys, or how does that?
If they're consultants, sure. Yeah. We'll have people like, hey man, I've been laboring on this new product launch for 6 months. I want to see it through. Great. Maybe we'll carve out a special, compensation package on the new product launch, and you help us launch it, and you see it through, and do a 50-50 profit share for 2 or 3 years just on that product on top of everything else, right? I mean, I think one of the things that is we're very flexible on deal structure and deal terms, and we really try and create a win-win situation for both parties. And Josh, our CEO, is the most creative deal structure minded person that I've ever worked with or seen out in Wall Street. So
pull a Warren Buffett, bring it out the napkin and sign it on the back of a car. Here we go.
Yeah. No, and then I mean,
I remember that.
my team, say the organization sometimes is like, oh, what are you guys doing? Like, we got to track all this.
So that resonates with me. During my whole career, I'd go to company. I worked for 4 failed startups, and I would make tons of work for these organizations. They would hate me, I think, right? Like in reflection, when I grew up a little bit, I'm like, I was probably the guy nobody liked at those companies. And now I'm the company owner and I make work for myself. I've never been more exhausted in my life. And now I understand what I put everybody else through. So yes, I do understand your sentiment there when you buy all those brands and then you dump them on your team. it's a lot of work. All right. So last question for you. And Ken, I found this interview very fascinating. You've shared a lot of intel, which is very kind of you to do so, because you don't have to. You don't have to show up on a podcast and talk about what you're doing. When you're the leader, you can be quiet and just do your thing and succeed. So good for you guys. But last question for you. If somebody wants to increase their evaluation for you or whoever they're going to sell to in the next 3 or 6 months, what would you say they should do?
Yeah, I mean, look, focus on margins and growth. Revenue growth and margins, right? I mean, it's a pretty simple formula, but it's not easy to do. Right. I think, I tell people, they always say, when's the best time to sell? Right. Obviously, you want to maximize value.
Yes.
Yeah. Right. I always say, it's like having a child or getting married. There's no perfect answer. But I would say from a buyer's perspective, we want to see upside. Right. So, I look at large businesses now, doing 100 million in revenue. And it's like, okay, it's exciting and you built a great business, but you're probably growing in line with Amazon, right? The cash flows and the profits are probably more stable, but there's less upside, right? In terms of, we're not going to grow that at 150% year one, right? So you look at that differently. So, I think you take it to the point where you feel great about it and you're like, wow, if I had X, this could be 2X, right? Or 3X the size. And if you don't have the capabilities to deliver X, that's the point where I think you should sell and, structure a deal where you do get to participate and you do find a buyer that has X and you think is going to deliver, because those are the great success stories that we've had, right? Whether it's time, capital, international markets, and this product would be great, or D2C, I just don't have the wherewithal to, set up a Shopify site, but it's, a high price point product. It's got the gross margin. We think it'd have great average order value. It's a repeat purchase, it's a brand, et cetera. Right. I think that's what I would encourage people to do, is just focus on obviously revenue growth, building healthy margins. Cause we also see, a lot of businesses that, kind of deleverage as they grow, because they built out infrastructure and their margin profiles actually shrink with scale. Right. So I think there's, what's that?
I'd say, yeah, not uncommon for that to happen.
Yeah. All right. So I think you want to, try and find that optimal point. I know it's not a hack or a tactic, but it's more,
sometimes think about it is the way to go. So that's perfect. Well, for those that are listening, we will be talking to a lot of aggregators this year. Make sure you subscribe to that playlist here. We're going to put that up on screen. Lots of other aggregator content. We're talking a lot about them. So this was with Ken Kubec, Vice President of Acquisitions at Thrasio. If somebody wants to sell their business to Thrasio, they could go to thras.io. Is that the best way to do it, Ken?
Yeah. Or email me or anyone on the team. There's an acquisitions@thras.io email, or mine's Ken at. So pretty funny story. It's just Ken@thras.io, which kind of gives you a little bit of lens into the origins and how big we thought we would be when we were just giving everybody first name email addresses.
I still do that, and now I'm having the questions about the scale. So I'm right there, Ken. I think you can give me some great mentor and advice. Appreciate all of your sentiment today. Thanks for coming on.
Yeah, thanks, Stephen. Pleasure.
All right.